Alright folks, let's talk about money. Not just the money in your pocket, but the money that fuels your business, your project, your dream. If you want any venture to succeed, you have to get a handle on its financial health. It's not about being a math whiz or an accountant. It's about common sense. You cannot build a lasting enterprise on shaky financial ground. It will crumble. That's why we're going to walk through the basics today. First up, let's talk about pricing. How much should you charge for your product or service? This is a huge question, not as simple as picking a number out of thin air. Your price has to cover your costs and leave room for profit. One simple way to think about this is cost plus pricing. Figure out exactly how much it costs you to make one item or deliver one service. Then add a specific amount on top for your profit. Example, it costs $6 to bake a loaf of artisanal bread. Add $4 for profit. Sell it for $10. It's straightforward, ensures you aren't losing money on each sale. Of course, there are other ways to price things. Value-based pricing. Charge based on how much your customer believes your product is worth. Example, a great consultant charging far above direct costs because advice can save millions. Penetration pricing. Start low to get a lot of customers quickly. Psychological pricing, like selling for $9.99 instead of $10. The key is to do your research, understand your customers, know your competition, and most importantly, know your own numbers inside and out. Now let's dig into those numbers. To set a price, you have to know your costs. Costs come in two main flavors, fixed and variable. Fixed costs are the bills you pay every month, no matter what. Think of your rent. Think of your insurance, the salary for your one key employee, the payment on a big piece of equipment. Whether you sell one item or 1,000, that rent check is the same. These are the foundational expenses. You must cover them to keep the lights on and doors open. Variable costs are different. They go up and down depending on how much you produce or sell. If you run a coffee shop, think coffee beans, milk, paper cups. The more coffee you sell, the more beans and cups you have to buy. Other examples, shipping fees, sales commissions, wages for hourly workers you bring in during busy times. You must track both fixed and variable costs separately. Knowing the difference helps you understand the true cost of each sale and how your profitability changes as your business grows. Once you know your price and your costs, you can find your break-even point. This is one of the most important numbers in your entire business. This is the exact number of sales you need to make to cover all of your costs. At this point, you aren't losing money, but you aren't making a profit yet either. You are, quite literally, breaking even. Every single sale you make after you hit your break-even point is pure profit. Let's make that real with an example. Imagine you want to sell custom t-shirts. Your fixed costs, things like website hosting, design, software subscription, a small marketing budget, add up to $1,000 per month. Each blank t-shirt and the printing materials cost you $10. That's your variable cost. You decide to sell each finished shirt for $30. So, your price, $30, minus your variable cost, $10, is $20. This is your contribution margin per shirt. Now, we just plug those numbers into the formula. Your break-even point is your fixed costs, $1,000, divided by your contribution margin, $20. So, $1,000 divided by $20 equals 50. This means you need to sell 50 t-shirts each month just to cover your costs. The first 50 sales pay the bills, but the 51st shirt you sell? That $20 of profit goes right into your pocket. The 52nd shirt? Another $20. Knowing you need to sell 50 shirts to break even is a much clearer goal than just hoping to sell a lot of shirts. This number is your guide. If you think selling 50 shirts a month is easy, that's a great sign. If selling 50 shirts a month sounds impossible, that's also a sign. It's a warning sign that you need to change something. Maybe your price is too low. Maybe your fixed costs are too high. Maybe you need a better marketing plan. Every business needs fuel to get started and to grow. That fuel is cash. This is called financing. Best way, your own money, or the profits the business generates. This is called self-funding bootstrapping. When you use your own money, you don't owe anyone anything. You are 100% in control. You answer to yourself. Ideal situation. Next best. Borrowing from friends, borrowing from family. Treat it as a formal loan with a written agreement to protect relationships. Sometimes you need more cash than you have. This is where you might look for outside funding. But be careful. Huge difference between debt and equity. Debt. Borrow money. You must pay back with interest like a bank loan. You keep ownership, but you get a monthly bill no matter what. Puts pressure on cash flow. If you miss payments, the bank can pursue business or personal assets. It's a serious commitment. Equity is different. This is when you sell a piece of your company for cash. You don't have to pay it back, but you give up ownership and future profits forever. Angel investors. Venture capital firms. They give money and get a say in how you run the business. They are buying into your future success. Brings expertise, but you are no longer the only boss. You share control and profits. Before chasing investors, look for smarter options. Many governments offer programs to help small businesses. Example, government loans in Canada. Example, US. Small Business Administration loans, often better rates and more flexible terms than regular bank loans. They want small businesses to succeed. Bottom line, debt is risky, giving up equity is expensive. Always try to use your own money first. Never take on financing until you have a clear, written plan for how that money will help you make more money. Review questions. 1. What are the key factors to consider when determining the pricing strategy for a new product or service? Answer. Customer value perceptions. Market research. Cost structures. Local market conditions. 2. How can understanding fixed and variable costs help leaders optimize their organization's financial viability? Answer. Differentiating costs. Break-even analysis. Optimizing costs and production levels. 3. What are some effective strategies for attracting investors to a new venture? Answer. Communicating value proposition, market potential, building relationships, presenting a compelling business case. 4. What are the advantages of government loans for Canadian organizations? Answer. Favorable interest rates, flexible repayment terms, access to expertise and networks. So, let's bring it all home. We've talked about some big ideas today, but they all boil down to a few simple truths. You must be in control of your finances. Financial viability isn't a mystery, it's the result of a plan. It starts with setting a smart price for what you sell. A price that covers your costs. A price that gives you a profit. Know your fixed costs. Know your variable costs. The break-even point is powerful. This is your magic number. It's the North Star for your sales goals. Calculate how many units you need to sell to cover your costs. That gives you a clear, tangible target. It moves you from wishful thinking to strategic action. Don't start a business without that number. We also looked at financing options. Here is your call to action.